Hey, good morning, or I should say good afternoon, everyone. How's everyone doing? Hopefully well. Always my favorite part of the week. Get to be with you guys, get to train you. Uh, this week we're going to continue the conversation about calculating income. I think the last week or the week before we talked about Schedule E income, the rental income, right? And we all understand how important income is, right? In understanding the income, making sure you know how to calculate it, making sure you know how to derive at it. And for this reason, I really want to concentrate on this. This is because this is an area where a lot of loan officers can go wrong. They can, if you don't calculate things correctly, it can definitely put you in a bad situation, especially if you have would-be buyers that thought they were approved and you issued an approval letter, you send them out shopping, and it turned out that maybe the income wasn't calculated correctly and they don't qualify for the amount that they actually are trying to purchase. And it puts them in a situation where they have to either cancel the transaction or not move forward with the deal because they cannot buy underwriting. It's not getting passed through underwriting. um, so oftentimes you're not going to have the opportunity to have your an underwriter to look at your income, and therefore we need to make sure that we're very strong in this area. So I'm going to give you a lot of tips, a lot of guidance in this area, just to make sure that you understand how important this is. Right, this is the one area that is left for open to us to make sure that we figure out this correctly. The other important thing is the credit report, right? But we really don't have any control of that. I mean, when you pull the credit report, whatever the FICO is, it is. You can use the what if and rescore plans. Of course, you can go down that route, but in essence, for the moment, the score is what the score is, right? Same thing with the appraisal, right? That's another important factor. But again, we have somewhat control of it in the sense that maybe we can influence the appraisal, or to give us a higher value or so forth. But we're also very limited there. In this area, the income is going to be what it is, but it's our job to make sure that we figure out exactly how the underwriters are going to be using this. And as a side note, keep in mind that there's a lot of you guys working with DPA programs, and you know they may calculate income differently, a little bit differently for the DPA purposes, not really for underwriting to determine whether they qualify for that DPA program. So just be sure when you are looking at the DPA programs or working with the DPA programs, make sure that you don't run into this. I know the California, the CalHAFA, they calculate overtime and bonus income a little bit different, and in a way to just kind of disqualify the bar. That I noticed that their methods tend to do that. Whereas, so in other words, they might get more income than what we might give them for the FHA loan they're trying to qualify for, right? So in that case, you might be trying to qualify income in one way for that DPA program, and then the other way for the standard loan that they're trying to get. So right now, we're going to focus on the standard loan, what the standard incomes are. But I do want to mention that because you can run into that. And just remember, when you're working with a DPA program, just make sure that there's no difference in how they calculate the income, and you don't get yourself in any trouble, because I do see some LOs getting themselves in a little bit of trouble when they're working with DPA programs. All right, so again, the training is calculating income. uh, Feel free to unmute yourself at any time to ask questions along the way. I'm not going to wait for a Q&A at the very end. Feel free to, let me actually open up my chat really quick so I can have it ready. If someone's not comfortable asking, feel free to chat a question. And again, this is an opportunity to pick my mind and make sure that you're satisfied with the answers I'm going to give you. And if you have a certain scenario that you came across and you want to bring that up, feel free to do so as well. So let's get started. So I know this is 101 stuff, and this is what we're going to start with, but I think it's important because I realize I've never really done this, and there might be some of you out there that don't know this. So I just bear with me if this is a little too simple for some of you, right? But I think it's a great place to start. So the easiest type of income to calculate is going to be your annual salary employees, right? So customer's going to tell you, yeah, I'm on a salary for 100, and in this case, I give you a couple examples. 200,000, right? And to figure out the income, it's going to be very simple. 12, you divide that by 12 months, and then the monthly income is 16,000. I mean, it just doesn't get easier than that. And by the way, in the LOS systems that we do have, Lending Pad, Blink, they have calculators on there, so you can actually plug in their salary, and it'll just it'll do the math for you and divide it for you. And if we have a little time, I can demonstrate that at the end. But very straightforward. I'm a salaried employee. So you're not hourly. No, I'm salary. I'm guaranteed 80,000 a year. Okay, perfect. So the bar tells you that, and you can look at the pay stub and see that he is on a salary. Sometimes it says on the top corner salaried or annual salary, whatever. Then you can confidently use this formula that you're seeing here, which is just take the salaried amount, which is right here. Oops, let me go back that way. The salary, the 200,000 divided by 12 gives you 16,666. If it's 80,000, it's going to be divided by 12, 6,600, and then 40,000 is going to be $3,333. Any questions on this? And yes, this is the gross amount. You're never going to use the net. Someone asked if this is a gross amount. In fact, all these examples, I'm going to give you the gross, except when we get to the Schedule C. The Schedule C is going to be, we're going to go off exactly what's on the Schedule C. But we're assuming these are pay stub W-2 wage earners. We're not doing any independent contractors in these examples. All right, so let's go on to the next type of income. The next type of pay stub you might come across might be the bi-monthly income, which means that they get a fixed amount twice a month, right? It's almost like a salary, and it may be a salary that's just broken up into two parts. But you'll come across this, where they get paid. In this example, I'm giving you two examples. So let's say they get 6,000 twice a month, right? So very simple. You just take the 6,000 times 2, and you get 12,000 a month for that borrower. The other example I gave you guys was 12,000. They get 12,000 from the 1st to the 15th, and then from the 15th to the end of the month, the 30th or whatever it is, then they get 24,000. And then the last example I have on here is 3,500 times 2. That gives you 7,000 a month. And again, we're doing this off of the gross. And you'll be fine. Let me see what the question here. Always confirm from a tax returns or what they are telling us. Okay, W-2 pay stubs. Yes, always confirm too. Like, if you're having a verbal conversation and you're just doing, like, let's say in a hurry type of pre-qualification, and you don't have time to look at the bank's the pay stubs or anything like that, or maybe they just sent you a copy of the tax returns without the pay stub, then make sure you at some point you verify before you issue the pre-approval letter, just to make sure, because they might understand it differently than what they're actually getting paid on. So just confirm, always confirm. That's why we get the documentation, because never trust a borrower. Just make that a rule of thumb. Just always get and confirm, and that's going to get you out of trouble. And again, we do these so that we stay out of trouble. We don't want to get in any trouble. And the worst thing you can do is send a customer shopping, the realtor shopping, and then they spend 3 or 4 weekends looking at properties, time, gas, money, energy, effort. Then
Pablo?
all right. So
Hey, Pablo, I'm
you
having
guys can
trouble
see my
hearing
slides,
you. You're
right? First, can you
glitchy.
nod? And you can see my slides that I have on here.
Pablo? It's Rhonda. Can I ask a question? Can you hear me?
Sorry
think-
about that, guys. I got disconnected, but I'm back. I don't
Yeah,
know what
you're really
happened.
glitchy, Pablo.
Am I glitchy?
Yes.
Okay, let me log in. Let me log out and log back in, because I don't know what the heck happened. So give me 1 second, guys. Sorry about that.
Can I ask you a question, Pablo, while you're
Yeah.
doing that?
Yeah,
The
can you hear me
question is,
though?
yes, I can hear you. The question I have is that I just got a new borrower presented to me, and she just started a new job. She's been working consistently for the last 2 years, but her income is a little bit more. So since she's only right now will have about one paycheck for the new job on October 9th, can I use that new income or do I have to go by her last 2 years of income? Since it's just it's a
is her new income salaried?
She gets paid bi-weekly. I don't know if it's salary yet. I have not seen the pay stub. She filled out the application a little funny. She put on her monthly income on Blink, but I don't think she did it properly. So, I don't know if she's salary yet.
Okay, so then we got to find that out first so we can figure out which of these formulas I'm about to give you is going to apply. So let me continue with the formulas. But the pay stubs, and by the way, can you guys hear me? Do I need to log off and log back in, or you guys are good?
We can hear you, Pablo.
Okay,
Yeah,
perfect. Thank you.
I
Yeah, it's better
understand your
now.
examples. Pablo, I understand your examples. I guess my question, I'll rephrase it, was that I want to know, can I use that new income if it's similar field, even though she's not been at that job very long?
Oh
Like,
yeah,
can
yeah.
it?
As long as it's the
Yeah.
same line of work, then you're 100% okay to use a new income. You never want to use old income. You want to use new income. What happens is that if someone switches jobs and let's say they're hourly, then we might have to do different formula to calculate the income just to make sure that we can account for the new income. So and I'll get that into the slides, but yes, to answer your question, yes, of course, as long as it's the same line of work. If you're going from, like, let's say, truck driving to nursing, then the underwriter might want to know how that because they don't have a lot of experience in the same field, so that might you'd probably still get away with that, to be honest with you, but because you can use a school as work experience. But yeah, just pay attention to that. It's important. Same line of field, you'll never have a problem. If it's a different line of field, you're gonna have some explaining to do. And as somehow if you can tie it in there, and if also if they spend a couple years in school learning this, then the education itself can be counted as work experience. That makes sense?
Yes, thank you.
All right, perfect, perfect. Thank you. Okay, so let's move on. The next one I have here for you guys is biweekly income, right? So biweekly usually means you get paid every other week, and usually it's an hourly income. And I've given you some examples, but the formula is very simple, right? It's you take the biweekly income, multiply it times 26. And the reason we're multiplying it times 26 because there's 26 pay periods for someone that's paid biweekly, and it's every other week. And keep in mind, someone that's paid biweekly, they can get there can be a month when they get 3 pay stubs. That can happen. So then if we use this formula, it's going to help us stay out of trouble. And you know that they're paid biweekly because you can see the dates on the pay stubs. That's going to be your first big clue and indicator on how they're getting paid. So pay attention to that because it's going to tell you if it's bi-monthly or bi-weekly or salaried or whatever. So that's going to be your big clue. Once you figure out what the yearly income is, then you're going to just divide it by 12 months and then you get your monthly. So sample one here, let's assume that the customer gets $45 an hour. That's what it states on the pay stub, right? And we know they're paid bi-weekly. So we're going to take 45 times 80 hours equals $3,600. And then $3,600 times 26 pay periods equals 93,000 a year. And then we're going to take the 93,600 and divide it by 12, and that's going to give us our monthly income that we can use to qualify. All right, next example here is same thing, $28 an hour paid bi-weekly, 28 times 80, 2240 is a bi-weekly pay. 2240 times 26 gives us the annual 58,240, and then 58,240 divided by 12.
Hey, Pablo.
Yes.
Hey, a shortcut on that hourly, you can just go 45 times 2,080 and then just divide it by 12. It just cuts out one step.
Gotcha. Okay. If you want to chat that in the group so that if anyone, and by the way, with math, obviously there's different approaches. So if you want to share that, what you just told me, perfect. This is how I've been doing it. So, and the other thing keep in mind too is if you put it on the LOS system, it'll help you calculate it as well. But this is so that you manually understand how this works, right? And all right, Any questions about this? Put in the chat or go ahead and ask the question. All right, and then the last one here is weekly income, right? So there's 52 weeks in a year. And so here's a formula, right? So we have to figure out, of course, we always have to figure out the yearly income divided by 12, and then you derive at your monthly income. So the first thing we're trying to figure out is the yearly income. So it's weekly income times 52 weeks equals yearly income, and then the yearly income divided by 12 equals a monthly income. Sample one, right? So we have someone making $36 an hour times 40 equals 1,440. 1,440 times 52 equals 74,880. And 74,880 divided by 12 equals 6,240. Pretty straightforward, you know. Next example here, $74 an hour. This one I put a little trick in here, and this person gets paid part-time, right? So if you look at right here on my example, wanted to throw you guys off a little bit. So a guy gets paid $74 an hour, but he's part-time. He's only guaranteed 20 hours a week. So then we take the $74 times 20 equals 1,480. 1,480 times 52 equals 76,960. And 76,960 divided by 12 gives us the monthly $6,413. And that's how we get at the income. And again, I put part-time because it's not always going to be 40 hours, and that's going to be true for any of the steps that we showed here. And I did this on purpose because I wanted to remind myself to make sure I pointed this out, that pay attention to what their hourly is, you know. So, and that's what the amount you're going to use, because you are going to come across bars that have maybe two, even three jobs. I've had customers that had 3 jobs. And just remember, the rule of thumb with part-time is that they have to have had it for 2 years. So just don't forget that one as well. Or in some cases, this may be a registered nurse, and this might be her full-time job or her only job, and she's getting paid $20. And I mean, she's only working 20 hours a week and getting paid this amount. I had a customer like that, actually. That's why I thought of this example. All right, so let's move on. These are considerations that we have to take into account when looking at any of these formulas. Obviously, our whole goal is to be accurate, right? We want to be as accurate as possible, because that's what's going to keep us out of trouble. So pay attention to see if the amount of hours worked are consistent. You know, does it appear that maybe like there was a couple months where they worked way more hours and then maybe some hours went lower like a few months later, you know? So when you're looking at the pay stubs, make sure you make pay attention to that. And one of the key indicators that might tell you that is the year to date. Does the year to date make sense? You know, the guy's telling you he's making 200,000 a year, but his year to date only shows 40,000, and it doesn't look like by the end of the year he's going to hit the 200,000. So that's when you got to start asking questions. Hey, what happened here? Because you got to keep in mind, the bar's not always going to voluntarily tell you things. They don't understand what we have to understand. They just understand that they get paid. Here's my money. Here's my paycheck. Here's my documents. Figure it out, right? So we have to do a little digging to make sure that we get the right information. And when you notice things that appear off, like in the example I just gave you with the year to date not making sense, then you got to ask questions, right? And the question might be, oh, I just got promoted last month, that's why and now I'm getting 200. Before I was getting 80,000 a year. I got a big jump. So at that point, you're most likely going to need to get the award letter, or I'm sorry, not the award letter, but the promotion letter from the employee saying that they were promoted to this new position and this is their new salary and so forth. So that way it makes sense to the underwriter. And if you get all this up front, honestly, it just saves you a lot of going back and forth. So you got to think exactly what the underwriter is going to be confused. And if you're looking at income and you're confused and you're not sure, then believe me, the underwriter is going to be confused as well, right? Other things you want to look out for is there alimony or child support, on the pay stubs? Are they paying things, car payments or anything like that? loans that they may have taken out from the company. So make sure that you always look at the pay stubs. Even seasoned loan officers like myself, I've made mistakes where I just, I looked at the pay stub really quick, and I knew the customer was a solid customer, but failed to notice the small details in the pay stub where it might say alimony, child support, anything, and then I have to back those things out of the income, and it puts my DTI at a whole different place. And it's very, very uncomfortable to be in that situation, right? When everyone's counting on you and you miscalculated the whole thing. So make sure that you're, no matter what, you're still looking at the line items on the pay stubs. Very important.
Pablo,
Is there,
if someone has child support, do they have to show their support order if they're getting income from their, let's say, ex?
yeah, well, they wouldn't be getting income from it. They would be getting a deduction.
No, I'm saying not, no, I'm saying it's not the no. If the wife, let's say, for example, is getting child support and she's applying for the loan, does she have to show the order that says she's receiving child support? That
Yes, yeah.
document?
So if she wants to use it as income, the wife, let's say the wife is the one receiving the income, as long as, remember the rule of thumb with any income, as long as it's continuous, there's a continuance for at least 3 years, then you're going to be able to count it. That's the general rule of thumb. 3 years. So if the child is 15 years old and at 18 the child support stops, then they're not going to count the income. It has to be at least 3 years out. So you're going to want the child to be at 14 and a half. So you're going to have to prove that the child is, that at least there's 3 years of continuance. Make
But I was
sense,
asking
Rhonda?
what kind of, yes, I was asking what kind of documentation is what I was asking. Do they
Yeah.
have to provide?
So most likely, like the legal documents that state what the support is, like if there's a divorce agreement or something from child services, anything that can document that she's receiving that income, and that when it, then you'll be able to use that income. And correct me if I'm wrong, anybody, but since it's not taxable, you can also gross it up. And I'm not sure if you guys are familiar with grossing up is, but we can talk about that in a minute.
Yeah, and FHA does it for 1.15 and the conventional is 1.25.
There you go. 1.15 for FHA and 1.25. And what that means is that because you're taking a net amount, and if someone doesn't mind doing the math and just putting it on the chat, if you took well, I guess we do easy number, it'll make sense, right? So if it's 1.25 and it's $1,000, then you're going to be able to use, I'm assuming, let me see, is that 1150? Let me see here. Yeah, 12. It's actually
1250.
at 1250. Yeah, it's actually 1250. Sorry, I've been in the mortgage business for a long time, and I'm not good at math. I'm just kidding. I'm kidding. I'm really good at math. But it's 1250. So that would be like the gross amount, right? So that's why they allow you to do that, because on the pay stubs, if you really think about it, you're not taking home the gross amount. You're taking home the net amount. And so to be fair, then that's why they allow the grossing up to take place. I should have done a slide on that. I'll probably add one on here so that I can talk about that, because that's just as important. You don't want to miss any opportunity where you can gross up the income. And again, the big clue for you, whether you're going to be able to gross up that income or not, is if it's non-taxable. If it's non-taxable, then you should be able to gross it up using that 1.125 for FHA and the 1.25 for conventional loans. All right. Bonuses and overtime. What do we do with those, right? In most cases, I want you to run DU and LP. And sometimes you'll get findings where it'll state that you only need 1 year tax returns or one W-2 and a pay stub. So if that's the case, you may be able to get away with 1 year of bonus or overtime. The rule of thumb is you have to have 2 years. And what you do have to do, and this is very important, I want you guys to pay attention to this, is on the LOS system or on UWM or any system actually that you're going to be running LP or DU, make sure you separate the base pay from the overtime and bonus. It has to be in its own category, because if you just lump it all together, then when the underwriter at UWM or whatever lender you send this loan to gets the file, they're going to put that overtime, or that they're going to categorize it and separate it away from the base. And it will change your findings, because now the system is going to recognize that there's overtime or bonus income, and it's going to tell you what type of documentation it wants to support that bonus or overtime, right? General rule of thumb is you should have at least 2 years of overtime or bonus income or any other type of income to be considered in the calculations for for figuring out your DTI. All right. So and again, you want to average that out for 2 years. The best way to calculate overtime and bonus is, I always like to tell the borrower to give me the last pay stub, the December pay stub for the last 2 years. So that way I can see when how much bonus they got, because on the line items on the pay stub, it's going to show you the breakdown of how much base pay they got, how much overtime, how much bonus, how much went to the taxes and all that, right? And it'll tell me how much bonus income they got. Now I can begin to do the average. And it's very simple, right? You take a year, so they got, for example, if they got $10,000 in 2022, and then they got another $10,000 in 2023 as a bonus, then you would just take that 20,000 and divide that by 24 months, right? And that's how you're gonna be able to use that bonus income. Just as important though is the underwriters will, you're gonna probably ask you to and by the way, that works out to $833. The underwriters may want a VOE, a verification of employment, to confirm that it's going to continue. There is a line item on the VOE on the right side that asks, is this likely to continue? If they don't check that, then there's a possibility that you may not be able to count it. Okay, so it's very important that you verify and you confirm with your borrower that this is likely to happen, right? And sometimes we get in situations where the borrower thinks that they're going to get it no matter what, and then the employer says based on economics or based on production or whatever, and then that might throw a wrench on things. So just be careful for that. Okay, you don't always have to submit a VOE, but a VOE can cause that issue, depending on if that's requested or not. Let me see what else. And same thing with overtime. All right, is there a big jump in income, right? I think we talked about that. Like, why is there a big income, right? And why is there a big jump? So you got to ask those questions. This pay stub doesn't make sense at all. And that may go back to what I was talking about earlier. They might have got promoted or maybe moved around in the company or something like that. Or maybe they got a big lump sum of money that was owed to them. We don't want to guess. We want to confirm and make sure we understand why the salary or the income doesn't match what's on the year to date on the pay stub. Okay. And year to dates, I'm always looking at those, by the way. Is there anything unusual? Like, I mean, for me, I'm in Los Angeles, and one of the things I hate calculating is the Los Angeles County employees have like the weirdest looking pay stubs. And they'll get one, it just has all these line items, and then it has like for Spanish, for bilingual, for this, and then the next one comes and it's not even nowhere near the same as the last one. And there's just so much moving parts on those, that to the point where I just order VOEs. I just go back to my processor and say, hey, can you just order a VOE? And it's okay, 100% okay if you don't understand the income. Like, I'm not going to pretend, even at my level, to understand all the incomes, and I've understood everything. So I go as far as ordering VOE so I can make sure that I understand. Because if I don't understand it, then I'm pretty sure the underwriter's not going to understand it. So I have to understand it to be sure that they're going to understand it. And ordering a VOE is always a great way to get very, very clear on the income. In fact, you can even get the VOE and email it to one of your AEs, or, for example, UWM has that pre-approval TBDs where you can submit. With UWM, you can actually just submit the income without any file or anything. I think you have to pay like 1,000 partner points or something like that. And they'll actually just calculate the income. Like they don't need to have a file or anything. You can just send that over, and then they'll help you figure out the income. The cool thing about letting them figure it out, especially on a tricky file, is that you have something in writing, and this is what they said that they're going to use. And as long as everything else matches to that, then you're going to be safe. And I've used that. I've done that myself with very tricky pay stubs, like where just things are all over the place. If it's a Sunday and and I've been or Saturday, no one's working, and realtor wants to make an offer and they don't want to wait for Monday to for me to issue the pre-approval letter, then be smart. Look at okay, so this guy works for the county. He has pay stubs I don't like. How can I come up at a safe number where I'm not going to get myself in trouble? So then I asked the bar, hey, do you mind sending me your year-to-date pay stub for 2022 and 23, and then give me your most current pay stub? So then I'm going to have 3 pay stubs. I'm going to have the one ending in 2022 so I can see what he made all year. I'm going to have the one in 2023 so I can see what he made all year in 2023. And then I'm going to have his current year to date, right? And I'm going to probably take the lowest calculation. I'm going to do several calculations. I may do a 2-year average between 22 and 23. I may average 12 months for 2022, 12 months for 2023. And then if, depending on the month that I'm in, let's say if we're year to date 2024, we're in October, then I might just do 9 months, right? So I'm going to do 12, 12, and 9, and then do an average to see what I come up with, and maybe use that average. So that's going to be 33 months divided by all 3 year to dates, right? And so that way I can come up with a safe number. It might not be accurate, but I know I'm going to be safe because I've taken almost 33 months of payments and averaged it out. And now I could say, okay, well, I don't know exactly what the income is. He actually might be even getting more than what I'm about to calculate. But if I can qualify him with this, then I'm okay to issue the pre-approval letter. And as you gain more experience and you get better at this, you're going to start seeing little things that you can do, like I just explained, where you're going to feel comfortable, like say, okay, I can derive at least at what I know he doesn't make below, right? If I can derive at what he doesn't make below, then I'll be safe, because if he makes more than that, then I'll just be safe, right? And if he qualifies with that very conservative calculation, then I should be fine. And oftentimes you're going to see that that's enough income and that you really didn't need to calculate anymore. And then you didn't need to make a big deal about calculating the income to the T. But again, that's going to come with experience. It's better that you familiarize yourself really well with how you calculate income, right? And by not doing so, I mean, it could be detrimental to your business. You may lose a realtor that could have been giving you loans for a very long time because you dropped the ball, didn't take the time, energy, and effort to make sure that you derive that a correct calculation. Remember, we get paid the big bucks. We're not out in the sun digging trenches. We're not, we're in nice, cozy AC offices. Hopefully you guys are. And we got to make a little time for this, especially when we're getting, $10, $15, $20,000 commissions, that, all this works out, really well and nice, so that the customer not only the customer, but the bar has a great experience with you. And here, the last thing I put on here, and I already spoke about it, is if the pay stub is too complex, do not hesitate to order a VOE. Run it by me, Denise. Denise was an underwriter before, so we can give you our thoughts on it once you get the VOE and say, hey, I got the VOE because this one was a little complex. What are your thoughts? What did you come up with? And then we can tell you what we would have come up with to determine the income for that bar. Okay. Any questions?
Pablo, how do you order the VOE, and what does it cost to do that? What's the process for that?
It's actually expensive nowadays, from what I understand. You can order them through, I think, Funding Suite. Some of the credit vendors allow you to order them. Sometimes if it's a big employer, they might be using the work number, so you're gonna have to use that. I don't know the exact cost. Last time I thought it was like $45. I'm not sure what it is. The other way would be if it's a smaller employer and they're not using it, you can just find out who the HR person is. Ask the bar, like, hey, who can I get the information for HR? And then you email it to the HR person and wait for them to complete it. And probably those are probably going to be the two best ways. The work number sometimes causes issues because they don't break everything down, as much as an underwriter would want. And I think if you've been doing this long enough, sometimes you run into issues where the underwriter wants more explanations than the work number can provide, right? So just be just be aware of that. All right. If the pay stub is too complex, do not hesitate to order the VOE. All right, and I think the last thing I want to show you guys is I'm going to show you a couple things, but last week I talked about Schedule E income. That's for rental properties, and something that I want you guys to pay attention to, and it's not very difficult to calculate at all, is Schedule C income. What is Schedule C income, right? And Schedule C income is going to be, and hopefully you guys can see this. Is the print too small? Let me see here if I can make it bigger. Oops. All right. Is that a little better?
Yes.
Okay. I know. Hey, I hate when I can't see things. But hopefully you can. This is a little bit better. So what's going to happen is that you're going to see a Schedule C, right? What's a Schedule C? It's a profit and loss from a business. And this worksheet, you're going to mainly find it under the 1040. And if you look right here in the top corner, it's a form that's found in the 1040. So think of it this way. It's someone that maybe didn't want to start an LLC or a corporation or anything like that, because if they had that, then they would have to supply you with a different set of tax returns. So this is something that you're going to find within the 1040s that the bar has. So you're going to come across this from time to time, not all the time. It's not as common, but you can. You may have a doctor or even a police officer. They have their day job, right? Maybe they work 3 days out of the week, and then they're running a business on the side, right? And this business could be anything. It could be a gardening business. It could be a home business. It could be I don't know if you guys are familiar, like with Prime America and some of these insurance companies, or they can be a loan officer even, part time. And what they do is they get a 1099, and they're either going to do it under their name or as a sole proprietor or under a DBA, but under their name. And what excuse me, what you're going to notice here is that what goes on here is going to be their social security number, right? See that social security number? And that's why they have to file the 1040, because this is going to fall under. That's why they have to file the Schedule C under the 1040, because it's going to fall under their social security number. And what they're doing with this document here is they're telling the IRS, they're telling the world, hey, I have a business here, and I'm doing it under my name. I don't have a corporation. I don't have LLC. And I derive income from this, because by law, we're supposed to all report our income, right? So this is the way you handle it with the Schedule C. And what you're going to notice on here is you're going to see, and this is a sample that me and Denise came up with, and we just wanted to, give you an idea of how this works, right? So you have gross receipts for $250,000. But we know that we're not going to use the gross, because we have to derive, businesses have expenses, right? They have operating expenses so that they can run. And the bar is going to write everything off that they can, so that they can, so that they don't have to pay taxes on the full amount, right? So in this case, we did a moving business, right? Antonio's moving business is what he named it, and maybe the bar's name is Antonio, so nothing complex there. We noticed that he reported $250,000 in gross income, and by the way, on the surface, this looks great, right? Because it looks like, wow, this guy's making a lot of money, and a lot of newer loan officers probably get really excited when they see this. But this is not the number we should be looking at, the 250. We got to go through the whole worksheet and see what it is that they wrote off, right? And looking at this, we're going to see that he wrote off $2,538 for advertising. Another $1,000 for car and truck expenses, maybe the moving, the gas, and all that. Maybe he had a crew of 3 or 4 people that were helping him, so he had to pay them $113,000, from the income he got, so that he could help them move. He was able to write off $40,000 in depreciation, probably from the truck expenses, depreciating or whatever. We'll just make that, or equipment, whatever. Insurance costs, moving, someone gets hurt, it's very expensive, so he has to pay for insurance. At the end, he has to maybe pay some legal expenses for whatever reason. Here on the right side, vehicles, machine, and equipment. I don't know if he had to buy some or not or whatever, but he expensed $30,000. Other business property, $6,000. Taxes and licenses, $800. And then meals, $700, right? So how much income did this guy, how much income can we use here, by the way? Anyone want to take a jab at it?
You said the line 29, 35,232, and then you add the depreciation.
Yes. Thank you, Michael. So depreciation, just like on the training that I did for the Schedule E, remember we talked about depreciation? What depreciation is, it's like a ghost. I use the word ghost. Maybe I'm using the wrong word. It's like a ghost write-off. It's not a hard or tangible write-off. So you're allowed to put that back. So instead of being $35,000, it's going to be $40,514, right? So that's what you're going to be able to use for the income. So you want to make sure you pay attention to that. And the rule of thumb is it's going to be, if it's a hard cost to run the business, then you're not going to be able to give that back, right? I know in some cases, and I don't remember correctly, but just make a mental note. And I was trying to verify this before I got on the call with you guys, just because I ran into it once and a while back, and I never ran into it again. But with truck drivers, if I recall correctly, you're able to give the meals back and do a little unique things with truck drivers. So if you're dealing with a truck driver, double check with the AE, or I'm gonna see if I can get more information for this on us. But I remember there was something that we can add back that had to do with like the hotel and meals. You know how they have to spend the night at places. But other than that, it's going to be a very simple formula like this, right? And let me see if I can slide over here and show you this other one over here. So and by the way, the bar can have multiple. Like I've seen some bars have 3 or 4 of these along with their salary or their hourly income, right? So this one, it's accounting, Stay Updated LLC. Looks like it's not a lot of income, 40,000 gross. And same thing, you can see the expenses here, right? $300 for advertising, $34 for commission and fees, $2,000 depreciation. Here on the right side, office expenses, $1,225, and supplies, taxes, license, and deductible meals. And then so the total income we're coming at is $25,945. And like Michael mentioned, we're going to be able to add back that $2,000 for the depreciation. And this income would go on top of whatever income you figured out for the W-2 portion of it, right? So if they reported $7,800 on their monthly salary at their day job, then you can come back and use this income and add it in there. And then if they have rental property, because they could also have a Schedule E, then you can do the same formulas I taught you guys on the last session and use that income as well in there. Now, the opposite, yeah, let me just finish. The opposite is true also if they have a loss. Like in other words, if this would have been a loss, and then you have to hit them with the negative of it. So if they would have been, instead of positive income, they were negative income by $500, then you have to hit them with that $500 negative. Same thing on the real estate. On the Schedule E, you got to hit them with the negative, and it will bring down their income. It sucks, but that's just the way it is. Go ahead, Rhonda.
Yeah, question was, do I need to know where that 2,000 is coming from? Like, I know you have to add it in to that line 29. But do I need to know how that 2,000 was figured out and the
No,
depreciation?
no, because again, it's just a deduction that you get for it's like a tax deduction. It's not a real hard expense. So as long as you see line 13, depreciation, you're good to just subtract it back. You don't have to figure out where it came from,
Thank you.
unless someone else knows something I don't know. All right. Any other questions about this?
There was a question in the chat, Pablo.
Let me see here. Per diem, what if the new business and they're showing losses in their first 2 years? Yeah, then you got to hit them with it. Yeah, you got to hit them with it, unfortunately, because it's a loss, right? So the lender doesn't like, so basically what you're telling the lender is like, I don't have, my money is not doing good. It's losing money. I'm having to dig into my own pocket for my other income sources to pay for this business that's not doing well. That's in essence what you're saying on here when you show a loss. So definitely, and by the way, to use self-employed income like this, you do need typically a 2-year average. You're going to need 2 years of them doing this. But I always tell people, like, if you're a nurse and you're also like moonlighting as an independent nurse or something like that, and you've been doing it for 20 years, if you run LP and DU and it only asks you for 1-year tax returns, you might be able to get away with just using the 1-year tax return. That's why for me, it's always been important to teach you guys to make sure that you guys know how to run LP and DU just to see what they're asking for. Because remember, we only have to turn in whatever the minimum documentation that DU and LP is asking us for. Okay. And good question, Michael. Since this was reported for, let's say, we have 22 and 23, and the bar hasn't filed their 2024 taxes, then you will need a P&L, a year-to-date P&L. So we got 2023 covered, right? But 2024, we're not even done with the year yet. We're 9 months into the year, so the underwriter is going to condition you for a P&L for the next 9 months, and it's super simple. I can, oftentimes what you're going to find is that these bars are not, they don't want to do it, or they're not sophisticated enough to do it. So then you ask them, okay, can you give me your monthly expenses and all that? And it's okay to help them, right? But you got to get the numbers from them. You can't be making up your own numbers and stuff like that. It's okay to help them. It's okay to type it up, but at the end they have to sign off on it. So that way you're not on the hook for, trying to manipulate anything or anything like that, right? And so and it's very simple, right? You take the month of January, what were the expenses? What was the income and what was left over? And then the next month, February, what was the expenses, what was the income, and what's left over? You don't even have to detail anything. Just monthly income, monthly expenses, and then what's left over. And that's the income you're going to be able to use. And use the 9 months, and you just average it out you can either take the last 2 years or the last year plus the year to date. So just pay attention to your DU and see how it wants you to do it. What if they have a business, but they are moving to a different city or state? If the business can continue, then you're okay. But if the business cannot continue, then the underwriter may want to understand how they're going to continue with the business, right? If it's a liquor store that's in California and they're moving to Florida, then they're going to want to know, like, hey, how are you running this business, right? And you can still run a business from afar, so it's probably just a good explanation letter to explain that would suffice, and you should be okay. But if there's no intention from the bar that they're not going to run the business, they're actually closing it down or whatever, then you cannot use the income. At least that's the technical answer. You cannot use the income. It has to continue. And if the bar voluntarily tells you, well, I'm going to terminate that business this year, then and when they'll tell you that, right? They're going to tell you that when you say, hey, wait a minute, you're showing losses here. I have to hit you with it. Oh no, I'm not going to continue with that business for next year. That's usually when you'll get that, because it's like the bar picks up on the fact that they messed themselves up, right? And that's why we have all these non-QM products, right? We have the bank statements, the 24-month bank statements, the P&L programs, and all that. And when you're talking to the borrowers, you got to tell them, look, you got to make a decision when you file your taxes. Do you want to get a better interest rate? Then pay your taxes. If you want to save on taxes, then you're not going to get a better interest rate, right? Because we know on the non-QM products the rates are higher. And they can't have both. They can't have the best of both worlds. They're either gonna file exactly what they need to file, pay their taxes, and then we can use all the income, or they can write up a lot of stuff, save money that way. But then that's how you can justify that the interest rate's going to be higher. Now, the cool thing about interest rate, it is a tax deduction, so usually, they like that. But that's usually how I present it to someone that's mad because we can't qualify them full doc, because they tend to write off a lot of stuff, what you can do, and what I've done in the past, is if, we're near, like, they haven't filed their taxes for 2024. Let's say we get into January or February and they want to qualify for a loan. I've had bars email me their tax returns, just the drafts. And I'll tell them, if you file it this way, this is how much you're going to qualify for. You need this much more to actually qualify. And then they go back to their CPA or whoever, and then they come back and give me a set. And I say, okay, with this set, if you file it like this, then you're going to be able to qualify, right? They're paying taxes on it. There's no fraud. They're going to file those tax returns. There's no wrongdoing. You're just letting them know, like, if this is the income you're going to use, then this is what you're going to qualify for. If you increase it to this amount, then this is what, well, not if you increase it, but if you were to report this much, then you would be able to qualify for that much. Bars are very hesitant to increase it just because they have to pay the taxes. But some bars may be okay with it because they want to qualify for that property. And as you guys know, if you've been self-employed for at least 3 or 4 years, most likely with LP or DU, you're going to get 1-year tax returns, so then they'll be able to just turn in 1 year's tax returns, and they'll be able to qualify, and you can run it through before. You could pretend like they already did it and run the AUS, run the DU and LP. And if it tells you 1-year tax returns, then you're going to be fine when you actually run it, because it's going to ask you just for 1 year's tax returns. So you don't have to submit 2 years, right? So just be careful for that. All right. Let me see what we got here. All right. Last thing I want to show you guys is that Fannie Mae has this cool calculator. Everything we talked about, believe it or not, there's actual calculator. So let me click on this calculator here. And this is you're going to find this income calculator on the Fannie Mae. And in fact, let me actually just copy the link if you guys want to save it. Here we go. Let me see if I could put it in the chat before I forget. And have this handy. I mean, this is a great way if you're a newer loan officer or even a seasoned loan officer and you want to figure out how to calculate income. This will walk you through the process of, let me make it a little bit bigger. Okay. This will walk you through the process of calculating the income, right? So welcome to the income calculator. This is by Fannie Mae. Who better than Fannie Mae, right? And you can actually import a file in here if you want, or you can just start a new evaluation, right? Self-employed. You can even, I don't know if you could do rentals. So you can do self-employed and just start filling out all these drop downs and fields. And then, you can put sole proprietorships. Schedule C is the one we're talking about, S Corp, partnerships, LLC, and everything. And then select the tax year, has a file. So we're going to say yes. And then you just start filling all this out. We're going to say it's a Schedule C, right? And see how it gives you the line items from the tax returns. I want you guys to play with this, and go in here, and whenever you get a scenario, just so that you strengthen yourself and make yourself have a better understanding of how to read these forms, right? These tax forms. So that's going to be on there. I put the link there for you guys, and it's just very simple, plug and play. It's a little time intensive, but it'll help you understand how these forms operate and work. And this is the one we were looking at. If you see this, and it'll give you all the items, and it'll help you calculate the income. All right. Before we wrap up, I'd like to open it up for some more questions. And if not, then we can call it a wrap. Yeah, MGIC has calculators as well. There's a lot of training videos. This is what's going to make you a strong loan officer, just getting really strong on the income, because this is the only part where it's really going to be up to you, to me, us, to make sure that we get this right. Everything else, like I mentioned, is going to, we don't have too much control of. We pull the credit, appraisal, other things, how much down payment the borrower has. We just got to work with what they have, right? But this is an area where you can learn how to calculate the income and make sure you don't also miscalculate or miss an opportunity to give them income in a certain area. So I just can't reiterate how important this is to all you guys. If you get really good at this, you're going to minimize all the issues that you're going to have when you're working on your transactions. And thanks, Mike. Mike shared the MGIC link there. So if you guys want to grab that one as well. I see there's no questions. It is going to be 2:00. Hold on. Let me see. Am I missing something here?
I have a quick question.
Yes.
Oh, okay. So I have a borrower and he's got an investment property and he's looking to do a either a standalone second or a HELOC to take funds out to buy 2 more properties. He's got a conventional loan as a first and doesn't want to touch it because of the interest rate. And he'd like to go conventional for the other 2. How do I plan all that out and make sure that he can support all 4 loans and not have a DTI issue?
So he owns a property. He wants to buy 2 more properties, right? Investments.
That's correct.
Okay. And I'm going to assume that you already know his annual salary and all his other income, right? The only income that we're missing is going to be the rental income from the properties, right?
From the other 2 properties, that's correct.
Yeah, it's a little tricky because the way that I like to back into that. So when a bar says, "Hey, I want to buy a property, but I'm not sure how much I can afford," right? And you'll come across, and by the way, this is a great question. You'll come across this with 3 to 4 unit properties, right? Like a customer comes at you and says, "I want to buy a 4-unit property," right? And it's going to be an investment. Well, you have 4 incomes 4 different incomes to play with in that 4-unit property, right? The question is, what type of rent can that 4-unit command? Here in Los Angeles, if you buy a 4-unit in Beverly Hills, just as an extreme example, the rents could be $6,000 for each unit, right? And so you have 6 times 4, you're gonna have 24,000. So then you have maybe that same fourplex, maybe 10 miles away in a different neighborhood, and it's only going to command $2,500 per unit. Now you're only getting 10,000. So I always like to ask a borrower, okay, where are you thinking of investing, in what areas, so I can have an idea of what the rents are going to be, and then I take 75% of that. Or the other thing I do is I ask them, okay, as soon as you see a property you like, find out what the rents are, get it over to me, and I'll plug them in. And so there's a little bit of back and forth you have to do, because it's all going to be the extra income we can use for those rental properties. It's going to be dictated by the rental income that property can command. That makes sense?
Yeah, I'm gonna have to do a little plug and play, like you said. I think the latter is gonna be what I need to do here.
Yeah, in general, in most cases, the bars have an idea of where they want to buy their investments, and then you can go. You have real estate access, right? So you can see roughly what the rents are going for. And like I know I know my areas here, so I kind of know what they can command, like the max. If they're vacant, even better, because you can max them out a little bit more. If they're already rented and they're already getting a certain rent, then you're gonna have to go off of that, right? Because that's what the rent that's being collected. So, but that's a great question, because that's a loose variable that you have to worry about, and you have to make sure that the borrower doesn't get it wrong. Like they don't get into the wrong property that doesn't give them enough income to qualify for that property. So I'm glad you asked that question.
And then do you add the depreciation on that?
No, there's no depreciation, because taxes are not filed. It's straight 75% of whatever is being collected.
Oh, okay.
The depreciation is once they've owned the property and then they file taxes, then you would do the previous formulas that I taught you guys on the Schedule E.
Okay.
But if it's a new property, it's going to be 75% of the rental income.
Pablo, it's Sherry. Can you hear me?
Yes. Hi, Sherry.
I'm myself. Hi. Hey, I saw in the chat someone asked about checking for a fabricated pay stub. And I just thought I'd interject that over the years, I've seen it all. But if it's not a direct deposit and it's just a check from the employer, I've even gone as far, to ask them for the employer to give the canceled payroll check to make sure it's legitimate. And I think twice about working with the agent who gave me the transaction.
Yes, thank you for sharing that. I am not talking about fraud because I know you guys are 100% honest, the best agents out there. So I have nothing to worry about. But now that you brought it up, let's talk about that. Where I see that you're going to be a victim of fraud, and I say victim because if you originate a loan that has a fake pay stub or fake bank statements, your name is on the 1003. And guess what's going to happen? People are going to start looking at you kind of funny, right? Because like, wait a minute, you're the loan officer and you couldn't catch a bad pay stub or something like that, right? So you're going to have the spotlight on you, and it's not a good place to be, especially if the lender audits the file. And I'll be straight with you guys. If a loan goes bad, then we either have to refi or get that loan back. If we endure heavy costs in doing that, our contracts with our loan officer state that you guys would be responsible for that. So you're always on the hook. Just remember that, and if there's been situations already with loan officers where they got caught, and it's just not a great place to be in because the spotlight's on you. Nothing happens to us. You're going to get blackballed from the lenders. They're going to report you to Fannie, and all this just bad thing starts happening. So, and in a lot of cases, you're not going to do the fraud yourself. And say in cases where you might fall victim to it, and the one that I can think of right off the bat is a realtor, hey, I'm calling you because they said that you're the best. And I tried getting this loan done with this other broker and they couldn't do it. And I want to see if you can do it, right? So I got the whole package. I'm going to send it over to you. You get the whole package. Everything looks great. You submit it. You're excited. You got a loan. But little did you know that, that realtor already tried doing funny business with the other loan officer, and they caught it. They stopped it. And now this guy's trying to get it through someone else, and that person could be you. And you get paid, it closes, and then 6 months later, the lender does an audit on it. They find out that the pay stubs and the W-2s were fake. And then we start having a very, very stressful situation. And you want to avoid that by all means. And you cannot say that you fell victim and just feel like you're going to walk away. That's why it's very important that you pay attention and make sense. If you work the way I taught you in this presentation to make sense and everything jives, then you're going to be okay, right? And like Sherry said, make sure on the bank statements you're looking for the net deposits, right? If they're getting direct pay, then the net deposit should match the pay stub net amount. And safeguard yourself, because there's a lot of scrupulous characters out there and people willing to take advantage, especially of newer loan officers. And you want to protect yourself from people that do that stuff, and yeah, and I'll leave you guys with that. Thank you guys so much for allowing me to help you guys with this process of becoming a loan officer. To me, this is my favorite day, my favorite time of the week, because I get to show you guys what I've learned and be a true mentor and broker to you guys. So enjoy the rest of your week. Rates should continue to hold steady and continue hopefully to come down a little bit. And this should start drumming up a lot of business for us. So I want you guys to get ready for the business that's going to come, or the business you can start getting now if you start working the opportunities. Thank you guys so much. We'll be in touch.